Hello, back with lecture 3 of chapter 6. So far we've talked about mostly gross domestic product and the four main categories that go into it. In this lecture we're going to talk about the other measurements that could be on exams, quizzes. Now there was literally, tens of thousands of categories under the income and output accounts for the found at the Bureau of Economic Analysis. And so we're just going to pull out some of the main ones to look at besides GDP. And so we're going to look at gross domestic income, which I briefly mentioned earlier. And so gross domestic income represents the cost incurred, and so these are the costs that are paid out by businesses to produce GDP, but these costs also represent income. So every time a business, again, hires someone to do some work or pays for a piece of equipment, that represents income to someone else. And so all this income right here, gross domestic income, is what comes from producing GDP. And so dollar for dollar, at the end, they're going to be the same. Well, by the way, the numbers for GDP might be a little different than when I went over with the previous lecture 2. And what I noticed when I was doing that is I got these numbers here. I was looking at the Bureau of Economic Analysis, and these were slightly different than the ones I had earlier. And that's because I took those numbers sometime in June, and these I just got from the Bureau of Economic Analysis in August, and so they were revised a bit. And that's what they do. They revise these numbers throughout the year. And so usually the numbers are finalized about 12 months, about 1 year after the end of the year. And so pretty much by the end of this year, we'll have the finalized numbers for 2019. Okay, now I do expect you to know on the exams the categories that go into gross domestic product, but I'm not going to worry about these over here. And so you can look at these if you want to. We have payment toward employees, surplus that goes to businesses. These are the profits. And then taxes on production and imports, we don't pick that up over here. Oh, I'm sorry, we do pick that up over here because I forget to mention that when we do buy things, they do include the taxes we pay on them. And so if you buy a bar of soap or something, the sales tax is included in our GDP. And that has to be added in over here. And because there's no depreciation on the left side, we have to add it in. We take out subsidies here because they're not included over here. They are included as income over here, and so we have to take it out. And then we have this statistical discrepancy, which is the difference between the number on the left column and the number on the right column. Theoretically, they should be the same number, but because they come from different data sources, they're going to be off a bit, and so they always have some kind of adjustment. And because they make an adjustment on the gross domestic income side, that tells me that the Bureau of Economic Analysis probably believes the numbers over here are more reliable than the ones here, and so they adjust this one to equal that one. And so again, theoretically and in practice, we just don't have enough, our measurement is not good enough that the gross domestic income is going to equal the gross domestic product. And that's why income does equal production. Okay, then we have our net domestic product, and again, net means you subtract something. And so the net domestic product is the same idea as we got our net investment. In both cases, we take out depreciation. And so again, up here in our gross domestic product, here we include money spent on depreciation. And the argument is that that doesn't really make us better off. We're simply replacing what we lost during the year. And so maybe a better measurement, some people argue, would be to take out the depreciation and just look at the net production, the net increase. And that would be our net domestic product. And so it's a very simple calculation. We take our gross domestic product and we subtract the amount of money spent on depreciation. And again, the technical term for the money spent on depreciation is consumption of fixed capital. And so your consumption of fixed capital represents all the money spent to replace equipment that was worn out during the year, became obsolete, or was damaged. And again, this would be known as our net domestic product. And so here again, we have a little equation. Net domestic product is equal to gross domestic product minus the capital consumption allowance. Again, that is the money spent on depreciation. And again, this might be a better measure to subtract out this spending because, again, it's not a net increase in what we're producing. And so for 2019, This is our GDP that we just got. We take out the money spent on depreciation, and that would be our net domestic product. Then we have another measurement known as gross national product, and if you look at old books, old publications, old news reels, I gave you data on the Great Depression that used gross national product. This was the main measurement we had up until I think about the early 1990s, and we still do collect data on it. It simply is not the number that it's not the one that gets most of the media play. It's not the one that we tend to compare with other nations. And that's because probably gross domestic product is probably a better measurement of what your economy is doing than gross national product. But gross national product measures the market value of final goods and services produced by a nation's resources, labor, land, and capital anywhere in the world, and that's the difference. Gross domestic product only looks at production done inside the United States, doesn't care who's doing the work. It could be a Mexican national, it could be a Canadian national, it could be a Japanese company. Doesn't matter, that goes into our GDP. So gross national product would not include work done inside our country by non-American residents. And so example here, let's say we have a U.S. citizen doing consulting work in Mexico. Well, that would go into our gross national product because that represents work done by a U.S. citizen in a different country. But that would not be picked up in our gross domestic product because it was not done inside the United States. So that would be on our gross national product, but not our gross domestic product. Production of Hondas in America, because Honda is considered a non-American company, then that would not go into our gross national product, but it would go into our gross domestic product because, again, that work was done here. And to be honest, my personal preference is gross domestic product. I don't care if it's a Japanese company, I don't care if it's a Mexican citizen, a Canadian citizen. If the work was done inside the United States, that's where the work was done, that's where the income was generated, and that's what matters. So GDP to me is the measurement to look at. But go ahead and collect data on gross national product. I'm not sure what you would use it for, but probably has some purpose out there. And then we have our national income, which measures the income earned through GNP. So it measures all the income earned through gross national product. And so that represents all the income going into households. And that is before taxes. Then we have our personal income, which is national income. Take away our payroll taxes. So it's all the income earned by households after the payment of payroll taxes. Your payroll taxes would be your taxes for mostly Medicare and Social Security, your FICA statement on your paychecks, pay stubs. It also includes any kind of transfer payments from government coming in, and so that would be if you receive, say, financial aid as a student, you receive Social Security benefits, you receive veteran benefits, that'll be after that as well. And then the bottom line is your disposable personal income, and that represents your personal income minus your income taxes. So this right here is probably what you might want to call your net income. You might call it your net income, you might call it your take-home pay. You might call it your after-tax income. And so there's two things to do with your disposable personal income, because you already paid your taxes. You can either consumption and or saving. So you can also think of your disposable income is equal to consumption C plus saving S, because there's two things to do with your money. That is, again, this is after taxes, that is a spend or save. And remember that because when we get to Chapter 8 and Chapter 9 on aggregate expenditure, we're going to talk about the propensity to spend. We'll have a thing called the marginal propensity to consume and a thing called the marginal propensity to save. Because again, that's two things to do with your income, your disposable income, and that is either spend or save. And when we get to Chapter 8, we're also, actually Chapter 8 and 9, we'll actually distinguish between the gross income for the United States versus the disposable income. And so when we get to that, I'll emphasize that as well. And those are the other measurements you need to know for any exams, and we'll stop there for Lecture 3.